On May 12, 2026, the average American paid $4.50 for a gallon of regular gasoline. That is 43.6% more than a year ago. In California, the price is $6.15. Crude oil is above $100 a barrel. Energy prices, according to the Bureau of Labor Statistics, rose 17.9% year over year in April. And on May 1st, ExxonMobil, the largest publicly traded oil company in the United States, reported that its quarterly profit fell 46%. Revenue went up, gas prices went up, oil prices went up, and ExxonMobil's profit went down. The numbers appear contradictory until you look at how this company actually makes money and where it lost it. ExxonMobil reported total revenue of $85.1 billion for the first quarter of 2026. That is a 2.4% increase over the same quarter last year. They sold more product at higher prices into a market with rising demand. By every surface measure, this should have been a blockbuster quarter. Instead, net income came in at $4.2 billion. 1 year ago, in Q1 2025, it was $7.7 billion, a decline of 45.8%. Earnings per share on a GAAP basis, $1 even. The prior year, approximately $1.83. The explanation lies in something ExxonMobil calls unfavorable estimated timing effects. These accounted for $3.9 billion in reduced earnings. An additional $700 million came from what the company classified as an identified item. Together, those two factors dragged reported profit down by $4.6 billion relative to what the company describes as its underlying performance. If you remove both, ExxonMobil's adjusted earnings were $8.8 billion. At that level, the quarter would have represented growth. Wall Street knew this was coming. Analysts had set the consensus estimate at 98 cents per share. ExxonMobil delivered $1.16 excluding the identified item, beating expectations by 18 cents. So the profit drop is real on paper, but the market treated it as expected and largely technical. The place where the loss concentrated is worth understanding. ExxonMobil operates in 4 segments. Upstream, which is oil and gas production, earned $5.7 billion. That segment benefited directly from crude above $100 a barrel. Specialty products earned $651 million. Chemical products earned $110 million. The 4th segment, energy products, which is the refining and downstream division, lost $1.3 billion. This is the segment that turns crude into gasoline, the segment that is closest to the pump price you pay, and it posted a loss. On an adjusted basis, removing timing effects, energy products earned $2.8 billion. The gap between negative $1.3 billion and positive $2.8 billion, a $4.1 billion swing, is almost entirely explained by those timing effects. When crude prices rise rapidly, as they did through February and March of this year, companies that hold physical inventory face an accounting mismatch. They purchased crude at one price, sold refined products at a higher price, but accounting standards require recognizing costs at current replacement value. The result is a paper loss that the company states will reverse in subsequent quarters. This is where the consumer disconnect becomes visible. You are paying $4.50 a gallon. ExxonMobil's refining segment, the one responsible for producing that gallon, reported a loss. The production segment, which pulls oil out of the ground and sells it at $100 a barrel, is where the actual earnings sit. These are 2 different businesses inside one company, and they respond to the same price signal in opposite ways during periods of rapid price acceleration. Meanwhile, in the same quarter that profit fell 46%, ExxonMobil reported achieving first LNG production at Golden Pass Train 1 in Texas, increasing total U.S. LNG export capacity by 5%. It delivered record production in Guyana. Capital and exploration expenditure rose 4% to $6.2 billion. Operating cash flow came in at $8.7 billion, down nearly 33% year over year, but still sufficient to fund both capital spending and the $9.2 billion in shareholder returns. The board also unanimously recommended re-domiciling the company from New Jersey to Texas. This is the position as of May 2026. American consumers are paying the highest gasoline prices since 2022. ExxonMobil's revenue increased. Its stock rose 48%. It distributed $9.2 billion to shareholders in 90 days, and its reported profit fell 46%, driven almost entirely by a $3.9 billion accounting adjustment that the company says will reverse in later quarters. The refining segment, the one that actually makes your gasoline, lost money. The production segment, the one that sells crude at $100 a barrel, made $5.7 billion. $4.50 at the pump, $4.2 billion in reported profit, $9.2 billion back to shareholders. These numbers coexist in the same quarter, in the same company, under the same set of oil prices that you experience every time you fill your tank.